Hey guys, it's Sebastian from Creator Capitalist, and today we're going to look at angel investing in real life and comparing it to Shark Tank. So this is another rebrand of this channel. It was called Passion Fruit, and then I learned that naming it after a Drake song is a terrible idea. It's still the same thing though. It's a back channel to the main Ask Sebi channel where we talk about topics that I want to talk about that you guys are curious about that won't do well on that main channel. As always, with pretty much every other YouTube channel, feel free to give this a thumbs up because it helps the algorithm. If you care about stuff like this, subscribe. And if you have any suggestions for videos, leave them down below in the comments and I'll try to see if I can fit them in. So taking a step back, as a quick background, I have been in the startup world for about 7 years now, started on the East Coast, did a startup over there where I was living out of the co-working space and I had my expenses down to about $500 a month. So pretty much what you expect when you hear people working on a startup and bootstrapping most of it. So once that one failed, moved over to the West Coast to do another startup. First, when we started with that one, we were living in a 1-bedroom in Mountain View with 5 people. So I was sleeping on the floor, pretty much also what you expect when you think of a startup. And once we raised some money, we ended up moving to San Francisco. After finishing off of that one, I've pretty much been helping startups with product as well as user acquisition, focused on the early stage. Mandy will probably cover this in a future video, but she worked at Techstars in the past and was employee number 1 at an e-commerce startup. She scaled sales from $0 to 80 million. One of the really cool things about working in the early stage startup world is that you meet a lot of really smart people and you see people working on ideas that you think and you're like, oh man, I wish I could start that. So oftentimes in those situations, when you see these really cool ideas, you want to invest in them. So for us, we typically invest something like $10,000 per month in different startups, tends to be $10,000 to $20,000 checks, and Mandy's also a limited partner in a bunch of venture capital firms. The reason I haven't talked about any of this in the past is because we've dealt with some stalkers. So we've had people go to our mailbox and wait outside of it for an hour, and we've also had other people show up at our co-working spaces or at our other offices, and it just got really weird. Half the time I'm not sure if they're looking for me because they like me and they want to say hello, or if they really hate me and they're going to stab me. So with the background out of the way, let's look into angel investing and whether it's something you should consider. In a lot of ways, angel investing is one of the worst investments out there because you have all the risk, you have a lot of downside, and the upside is very occasional. So what I mean by that is most of these companies are probably going to go out of business or just not exist in the future. You might have some companies that have maybe a 3 to 5x exit, and then you hope that you have a few that are 10 to maybe 100x. I'll probably cover this more in future videos if you guys want more information, so let me know down below. But you have a bunch of disadvantages. You can't really sell them until later on, so you're typically holding until either an IPO or an acquisition, or if you come up with some secondary share options in the future when you're close to an IPO, then that might be another exit point, but you're typically holding. Unlike a lot of other assets, you don't really have any recourse. So unless there's fraud involved, then you're not really going to be able to recoup anything. If you invest in a house and you decide to sell that, then that's going to be easy. You have something to get back. The other thing too is that oftentimes, depending on how you're investing, you might need to be an accredited investor. So there are some platforms that do not require this, but in most cases, I'd recommend being accredited in order to get into some of these deals. This means that you either need to have $1 million in liquid assets, so this is ignoring your house, make $200,000 by yourself, or make $300,000 as a couple. And you have to do this for the last 2 tax years. There are some changing regulations here, and I think that's a good thing because it doesn't make sense to me that you can invest in options and these crazy other vehicles and not invest in startups. This is also one of the weird cases where you would want to live in a high cost of living city. So yes, $200,000 goes really far in Texas, but it doesn't really go as far in San Francisco. And the other thing too is that the salaries in New York, San Francisco are inflated due to this higher cost of living. This makes it pretty strange because there's people coming out of school who easily make $150,000 to $200,000 in total compensation due to the competitive nature. Again, there's a ton of different topics, micro topics within each of those, so let me know down below if you want me to do deep dives for anything. So we talked about my background and then also what angel investing is as a quick precursor. Let's look into some misconceptions. The first one is that it's going to be the founder pitching to a panel of people. When you watch TV for this, they're making a deal, they're doing all this stuff. There's a lot of theatrics there. In real life, it tends to be one-on-one meetings. In the past, it was over coffee and meetings, and now it's more so Zoom. It's still that one-on-one relationship versus pitching a room full of people. If you're someone who wants to start investing, your best bet is to either talk to your friends who are in that early stage game and then see who of their friends are starting companies. Angel investing in a lot of ways is very network driven. So there are two occasions where you might pitch to a panel of people. The first one is if you go through a startup accelerator, and then towards the end you have something called demo day. So Y Combinator has a pretty big demo day where you pitch to a bunch of people, but even then you're not making the deal based off that pitch. That's like a 1-minute pitch to see who's interested, and then you schedule secondary meetings. That's pretty much just you telling a room full of people, this is what we're working on, and email us if you're interested. The second other time that you see this panel is one that I would actually avoid, whether you're an angel investor starting out or whether you're a founder. So there are some predatory angel networks out there that will ask you to either give them equity or to pay them in order to pitch. So this used to be pretty common, but there's been angel investors and also VCs that have shamed these people because it's predatory. On the East Coast, it still happens, so that's something that you want to be careful with. So oftentimes it might be a bunch of people who are professionals. It might be dentists, doctors, lawyers, investment bankers, people who have the money and they see Shark Tank and they're like, hey, I want to do that too. That looks pretty cool. The main issue is that oftentimes they don't have the best interest of the founders in heart. And even if you end up doing a deal, it might be such that it makes it very hard for that startup to raise subsequent funding. The absolute worst version of this that I've seen in Boston is they charged 20 startups $2,500, and then with all that money that they charged everyone, then they invested that into one of the companies. So they're not even investing their own money, they're investing money that they got from all these other startups. So that's kind of why it leaves a bad taste in most people's mouth. On a side note, if you're someone who wants to start and you don't really know where, I'd recommend checking out the resources down below in the description box. Some of these are going to be books, other ones are going to be blog posts, and they tend to be the best starting point. Also, if you're an accredited investor, there's going to be a mailing list down below. Number 2 is going to be valuations. So with pre-seed startups, you're typically looking at something like $5 million to $12 million valuations. So pre-seed means that they're either just an idea with an MVP, so a minimal viable product, and then maybe some traction. If you invest $100,000 in a company that's valued at $8 million, then you're getting 1.25% of the company. $10,000, that's 0.125%. As a reminder, you might have some dilution as well if the company is successful because they're going to sell additional shares. For most people, I would avoid pre-seed startups because I think they're very hard to judge. A lot of the times you're not really judging even the product, you're judging the team and their ability to execute. Next is going to be seed stage startups. Most valuations right now are about $8 million to maybe even $40 million, depending on the company. Oftentimes, this means they have the product and they either have some initial users or they already have some traction. If you invest $100,000 in a company that's at 20 million valuation, then that's 0.5%. At $10,000, you're getting 0.05%. A good example of this earlier this year is Rome Research, which had a $200 million valuation. So if you invested $100,000 there, then you're getting 0.05%. Number 3 is going to be negotiating. So on Shark Tank, they do this a lot because it's theatrics, it's TV, and they have to do something, otherwise it's not interesting. But I would argue that it's not very common, especially the weird debt covenants that people tend to do on Shark Tank where they give you a loan or something. That's kind of common in Europe for their venture scene, but not very common in the US. Over here, it tends to either be a yes or no decision. So if you like the valuation, if you like the company, then yes, you're putting in money. If you don't, then it's a no. And that's going to be normal people who are angel investing, maybe $10,000 to $100,000. If you are someone leading the round, so if you are putting most of the money in for that fundraise, then yes, you can negotiate. Generally though, if you're not the one putting $500,000 or $1 million in, you can't really negotiate and it's not really good form. The other thing too is that for most people, you typically want to invest in 10 to 30 companies to be diversified enough, so it's not very likely that you're going to be leading rounds. Number 4 is going to be profitability and cash flow. So on Shark Tank, there's a very big focus on how much money are you making right now and what does the cash flow look like. In a lot of ways, Shark Tank is closer to private equity, where they're looking at cash flows and looking at businesses that don't have the potential to grow very substantially. Another way to think of it is that angel investing is paying a discount on the future potential of a company. A lot of this also depends on the specific sector and what you're looking to do. So if you have a physical good, then yes, margins matter quite a bit. On the flip side, if you're someone trying to start a social network, if you're trying to start a bank, then that's a very different problem. There's an understanding that early on, you're going to be hemorrhaging money. You have to hire people, you don't really have revenue figured out, and you probably have to do promotion to get people in the door. So if you look at something like Robinhood, they're giving out free shares in order to try this platform that wasn't really as big as it is currently. Investors are betting on the future that this can disrupt the whole industry and it can be $1 billion company. If you look at something like Chime or a lot of the other fintech services, the strategy is that you have a loss leader. So you have something where you lose money and then you make money back through either debit cards or through credit card transaction fees. For fintech, that's pretty much the golden goose, and that's why all these other players are launching debit and credit cards, because it makes a lot of money. We've even seen startups that are specifically just credit cards for businesses become billion-dollar companies in less than 2 years because of the space. So it's less about how much money they're making right now and more about how much money they can potentially make in the future. I think a lot of traditional investors aren't really comfortable with that because that's not what they're used to, that's not what they're taught, and that's the hard part about early stage investing. If all of that sounds pretty interesting but you don't really know where to start, my recommendation would be to sign up for AngelList syndicates, just because that's probably the easiest thing you can do. You still get to evaluate the deals, so you're not signing up for every single startup that goes through that syndicate, but it means that you have deal flow and you have an idea of what to look for, especially if you are very new to the startup world. Again, link down below if you want to sign up for that mailing list if you are an accredited investor, and let me know down below whether this is what you thought it was or whether it's a lot more different. Big favor is to give this a thumbs up and share it if anyone else would benefit, but otherwise hope you guys liked it. See you guys next time.